The stock market stands as one of the most potent financial systems ever devised, a global marketplace where ideas become enterprises and enterprises become legacies. Since the early days of organized trading, markets have offered individuals the opportunity to participate in economic growth on a scale never before possible. Over decades, patient investors have turned modest sums into significant outcomes, not through luck, but through discipline, research, and a deep understanding of what it means to take calculated risks. Yet, with opportunity comes uncertainty. Markets do not deliver returns on a schedule. They reward resilience and long-term thinking. There is a delicate balance between risk and reward, and nowhere is that balance more pronounced than in the world of penny stocks. Shares priced below $1, or in this case, under 20 cents. Less expensive does not equate to less meaningful. In fact, some of history's most dramatic market stories have begun with humble, low-priced shares. In this narrative, we explore how tiny prices can reflect big potential, not through hype, but through real company stories, performance trends, and marketplace context. This is a story about possibility tempered with realism, where knowledge matters more than noise. Today's economic world is interconnected and dynamic, shaped by rapid technological shifts and evolving consumer demands. Across sectors, companies of all sizes compete for capital, innovation, and market share. Among them, a particular subset of publicly traded entities attract the gaze of investors seeking asymmetric outcomes: penny stocks. These low-priced shares often represent small-cap companies operating in niche corners of the economy, from biotechnology and healthcare to real estate development and emerging technologies. Although often overlooked by institutional investors due to liquidity or scale considerations, these companies still play a meaningful role across industries. They operate in a range of environments: clinical laboratories, developing treatments that address unmet medical needs, real estate firms shaping the spaces where communities grow, and micro-enterprises navigating competitive commercial landscapes. Their operations extend across cities and sectors, each contributing to employment, innovation, and the broader economic tapestry. For consumers and investors alike, the influence of this segment may not grab headlines every day, but it is present in the innovations that influence daily life and in the capital markets that connect companies to global funding sources. In the modern era, a company's impact is measured not just by size, but by its relevance, adaptability, and the markets it serves. Understanding how small companies generate revenue, manage costs, and respond to industry trends is essential for anyone studying market structures today. These firms serve as a window into the entrepreneurial spirit that fuels economic expansion worldwide. The first company we examine operates in the veterinary health sector, with a focus on diagnostic and therapeutic tools for companion animals. Its business model revolves around point-of-care technologies used in veterinary clinics, with revenue derived from sales of diagnostic systems and related consumables. This model aims to generate consistent cash flow by positioning its products as essential tools in animal health practices. The company's recent share price has hovered well below 10 cents, a reflection of both market volatility and investor caution. Another company under review is a real estate development firm trading just below 20 cents per share. It engages in residential and mixed-use construction projects, generating revenue through project sales, leasing strategies, and property management services. Its financial profile is modest in size, but indicative of the niche nature of its operations, and recent trading volumes have shown investor attention in this low price bracket. The third entity on the list is a microcap share with recent trading activity, showing prices near 11 cents, based on volume-driven screens tracking the most actively traded penny stocks. Its business operations span a less defined commercial sector, with revenue streams that may include services or small product offerings that attract speculative interest. Across all three, the common thread is market confidence tied not to size, but to potential and narrative. Their latest performance trends show significant price fluctuations, a hallmark of low-priced shares. Recent developments in each case include changes in trading volume and public visibility, factors that contribute to short-term movements. Yet, underlying these movements are business fundamentals that vary widely, from tangible product sales to speculative turnover, and all warrant close observation and analysis. Up until now, we've discussed these businesses in general terms, emphasizing industry context, business models, and market behavior without revealing specific identities. Now, it's time to put names to the stories. The veterinary diagnostics company we introduced is Zomedica Pharmaceuticals Corp. Trading at approximately $0.06 per share, this company has developed point-of-care systems used in animal healthcare practices and seeks to grow its market penetration through technology adoption and sales expansion. The real estate development firm is Safe and Green Development Corporation, which has been trading near zero by 19, focusing on residential and mixed-use real estate projects in select markets. Its operations underscore a traditional revenue model rooted in property development and sales. The third name is ATPC, a stock noted for active trading at roughly 0.11 in recent screens that highlight volume and momentum among low-priced shares. While its business details may not be as widely documented, its activity in the penny stock arena reflects investor interest in microcap liquidity dynamics. These companies stand out not because they are household names, but because they occupy distinct corners of the market where share price is low, volatility is high, and narratives vary widely. Investors watch these names closely, not with the expectation of certainty, but with an understanding of how small caps can behave when news, earnings, or speculative flows intersect. In the broader landscape of the stock market, cheap share prices do not inherently signal value or lack thereof. Instead, they spotlight companies at different stages of growth, challenge, or revaluation, each contributing lessons to an informed market participant. Zomedica Pharmaceuticals Corp. traces its roots to a vision of bringing advanced veterinary diagnostics to everyday practice. Its growth journey features milestones in product development, trials, and market outreach. However, like many biotech ventures, it has faced challenges including fluctuating revenues and stock price volatility. Its competitive advantage lies in proprietary diagnostic tools, yet risks remain in adoption rates, regulatory hurdles, and cash flow sustainability. Investors closely monitor quarterly results and adoption metrics for real indications of stability. Safe and Green Development Corporation's narrative follows a more traditional path: real estate development. Its milestones include completed projects and secured land deals, but challenges stem from macroeconomic headwinds that affect construction costs and buyer demand. Real estate firms often benefit from localized markets, but they also face cyclical pressures. Its strengths include tangible assets and revenue potential from property sales, though thin margins and capital intensity remain realistic concerns. ATPC, as reflected in active trading screens, highlights how market attention can drive pricing absent detailed fundamental data. Its competitive context may include niche services or microcap positioning, but liquidity and speculative interest drive much of its trading behavior. Risks are high here. Flows can shift rapidly, and fundamentals can be opaque compared with larger peers. Across all three, short-term perspectives focus on volatility and trading patterns, while long-term views require deeper financials and company disclosures. Competitive advantages vary by sector. Proprietary tools for veterinary diagnostics, location and project execution in real estate, and trading liquidity or niche operations for microcap names. Risks are inherent: low liquidity, market sentiment swings, and the challenge of scaling revenue. Looking ahead, each company's potential is shaped by distinct industry trends. In the animal health sector, Zomedica stands at the intersection of growing demand for in-office diagnostics and technology-driven veterinary solutions. Wider adoption of point-of-care tools could support revenue growth if clinics incorporate these systems into standard practice, though this momentum depends on demonstrated utility and competitive alternatives. For Safe and Green Development Corporation, future prospects hinge on real estate market conditions. Urbanization trends, housing demand, and regional economic health influence growth potential. If the company can secure financing and navigate construction cycles efficiently, it may enhance its project pipeline. However, external factors like interest rate environments and material costs will continue to play a significant role. In the case of ATPC, outlook is less tied to a specific industry narrative and more to trading dynamics. Activity among small cap traders, shifts in liquidity, and evolving market sentiment contribute to its trajectory. Microcap stocks often reflect broader economic cues and speculative flows, and their path can be unpredictable compared with companies rooted in defined commercial models. Across all three, realistic expectations must account for slow, incremental progress rather than dramatic turnarounds. Broader industry trends, healthcare innovation, real estate demand patterns, and small cap market behavior will contribute to how these names evolve through 2026 and beyond. Ever wonder about those stocks trading for less than a cup of coffee? I'm talking about penny stocks, specifically those under 20 cents. Each one tells a unique story. Some are startups with big dreams. Others are established companies facing a tough time. It's a world where huge potential and serious risk live side by side. Jumping in without doing your homework is like navigating a maze blindfolded. The key isn't to chase instant riches, but to understand the business behind the stock price. What's their plan? What's their market? This isn't about quick flips. It's about seeing the bigger picture and learning from every investment, win or lose. So, if you're curious about penny stocks, remember to do your research, think long term, and be honest about the risks. Thanks for watching, and don't forget to subscribe for more insights.